Well, good afternoon, everyone, and just quick update from us on the goings on across financial markets this week. We'll start with the calendar. We'll have a quick flick across the calendar where really none of this has seemed to matter throughout the duration of this week, apart from the CPI print out of the US on at 1:30 on Tuesday. Now, what we saw across the total, the total economy, the total inflation rate, the year-over-year figure, excluding food and energy, as they are quite volatile components of the CPI print. What we saw is the previous was 8.5, right? Consensus for 8.1, a quite sizable drop in the rate of inflation across the total economy, but we actually came in a little bit higher than anticipated as 8.3, as you can see there. But that, I don't think, was the main focus of markets' attention. What was the main focus of markets' attention was the core CPI print, right? Once you exclude food and energy, the total inflation rate includes food and energy. The core inflation rate excludes food and energy, as they are quite volatile components, as I said, of the CPI print, right? The previous figure was 5.9%. We were expecting 6.1, and we actually came in 6.3. So pretty much ties the Fed's hands. They've got to continue on their aggressive rate hike cycle. And that opens the door for a 100 basis point hike coming into next week, which we will have a look at in a minute. Apart from that, we had a raft of data out of the UK. We had GDP, the month-over-month figure on Monday, coming in slightly below anticipated. Consensus was 0.4, actual 0.2, a little bit lower than anticipated. We come across to the unemployment rate, which was slightly positive figures. The unemployment rate has ticked down, but we've come into the inflation figures, CPI print, and that has come in a little bit lower than anticipated on Wednesday. We'll then come towards today, and retail sales, consumer spending within the economy does not remain strong. We were expecting a minus 0.5% decrease. We actually got a minus 1.6, but although it's a raft of data out in relation to the pound, I think there was a lot more things stacking up against the pound rather than just these figures. You've got the Bank of England predicting predicting a recession over the back end of this year, last quarter of this year, plus the 4 quarters of next year as well. You've got the cost of living crisis, soaring energy costs, not double digit inflation anymore, was double digit inflation, and really a lot of things stacking up against the UK economy. We had a couple of negative prints. The only positive print was the unemployment rate, which is not really the central bank's main focus of attention at the moment. What we're expecting is them to continue on to look at inflation, but GDP and retail sales, consumer spending and growth slightly negative over the course of this week, so that has continued to send the pound lower. But we'll jump over to the charts, and really the main focus of attention was that CPI print. Now, we've had quite substantial downside this week over this S&P. We still continue to print fresh lows on the S&P. Haven't seen these lows back since the middle of July, 6-8 weeks now, 2 months now at this point. So we are printing fresh lows in the S&P, and we do seem primed for an attack at the yearly lows back at 36.50. Definitely something to keep an eye on into next week, with the Fed being next Wednesday. I can't imagine many people will want to get long stocks into the Fed, so I think being short stocks is the way to go into the Fed next week. We've got yields, the 10-year yield in the US pushing higher off the back of expectations for increased interest rate hikes. That continues to march higher. We are testing off these lows up at 3.5, and I think they are important. That is an important number, an important line in the sand when it comes to that 10-year yield. Any break above that would probably then suggest that stocks continue lower and the dollar continues its march higher. Now we move on to the dollar, and we look at the Australian dollar. That has also taken a hit this week with the continuing deterioration in risk sentiment, yields pushing higher off the back of interest rate hikes. You've got the S&P pushing lower. That then in turn affects your risk sensitive currencies, as we can see the Australian dollar posting fresh lows, fresh yearly lows again. We come back to the Kiwi again. On the Kiwi, we're doing the same thing, posting fresh yearly lows. We then come to dollar CAD, and that is doing the same thing of printing fresh yearly highs. Now that level of 132 had seemingly held for a number of weeks, a couple of months, but we are through that over the course of yesterday and today, and I think we will definitely get a close above that barring some craziness towards the back end of this week. We'll come across the dollar yen. Dollar yen's a bit of an interesting one. Dollar yen's trend has stalled, which I think is quite interesting. And most of the rest of the dollar pairs, whether it's cable, Aussie, Kiwi, dollar CAD, all pushing higher. Dollar Swiss is kind of ranging at the moment, but euro dollar and dollar yen are quite interesting charts, I think, at the moment. This dollar yen chart, we had reports earlier on in the week that the Bank of Japan actually went to do a rate check with a bank to see how the rates for exchanging dollars into yen or selling dollars to buy yen would actually work out. Right, that was then met with a slight bit of downside in dollar yen, but we have since had a member of the Bank of Japan come out and suggest that Japan just simply do not have the resources to push that chart lower. So they are potentially wanting some help with the Americans, and the Americans have got other things to deal with other than Japan's currency. So I think that's something to keep an eye on going forward. If you just blow the chart up and stick it on the weekly time frame, this thing is trading like a penny stock. That is one of the biggest countries. Well, it is one of the biggest countries, but one of the biggest currencies in the world, trading like a penny stock, which is not something you see very often. Now, if the Bank of Japan do not have the resources to get this under control, I think they are powerless really to do anything. But with the debt to GDP ratio in that country, raising interest rates massively to deal with this is probably not the best idea. So I think the Bank of Japan and the Japan economy itself probably in a slightly difficult situation going forward. So I think dips on the dollar continue to be bought. Dips on dollar yen, I think, continue to be bought. Even if we're stalling up here at 145, hopefully you may see a break above that, especially if we can get a hawkish Bank of England, hawkish Fed next Wednesday evening, which I think they don't really have a choice but to be hawkish, because if they are not hawkish, if they come across slightly dovish, what that does is it sends commodities higher, it sends stocks higher, and causes further sustained levels of inflation. So that is the opposite to what they are trying to achieve. So that brings us then on to next Wednesday. When we get the Fed. I think a lot will be made about these economic projections. They're going to massively upgrade their economic projections. We're going to have to wait for the rhetoric around this press conference and see any forward guidance. But any forward guidance of the Fed is not probably worth listening to. They will say that they are probably data dependent, and what the data says is inflation is still growing. Once you exclude food and energy and you look at the rest of the economy, inflation is still growing. Whatever they come across and say on Wednesday, they have reason to be hawkish again, but no matter what they say, they will be data dependent going forward, and what the data suggests is inflation continues to rise. Apart from that, we get the Bank of England. We're expecting a 50 basis point hike in the Bank of England. I'm not sure that really changes much in the picture of the UK economy. I think if anything, if you get a 50 basis point hike and sterling moves higher off the back of that, personally I just think it's better levels to sell at. Really, I think the cable chart and also sterling by itself remains a sell on rallies heading into next week. We've also got the Bank of Japan. Bank of Japan, interestingly, after what I said earlier about dollar yen, with them going to, or potentially going to, a bank to check out the exchange rates for dollar yen, see what they can do, to also maybe asking the Americans, can they do something about it? I think the Bank of Japan may be interesting next week. Some rumors in markets that they were considering doing something to try and support the yen and stop the sell-off, but they have not done anything they've not done anything yet. They talk and they say they're going to do something, but until we get some action, I still think that dollar yen chart is a buy on dips. But apart from that, we're not got a great deal to go off. Apart from that, we're not saying not got a great deal to go off. We do have a good deal to go off next week. We got the Fed, Bank of England, the Bank of Japan. We do have some central banks out, but they are largely sticking to the same script, continuing to be hawkish, saying that they are now data dependent going forward. So if all the central banks are saying the same thing, we cannot really take much direction off of that in the medium to long term. Short term sentiment may be dictated by that, but we will cross that bridge when it comes to it next week. But that's it from us then for this week. Got a long weekend in the UK. We've got a bank holiday on Monday for the Queen's funeral, so again, if anybody's watching that, our condolences from everybody here at LAT if that affects you. But apart from that, we'll be back in order on Tuesday, and we'll be back next week for another weekly market insights. Thank you.